This is InvestTalk. Independent thinking, shared success.
Yes, my name is Jeff from Iowa, and I just have a question about Zoom. Just want to know if right now, if where it's sitting, if it would be a good buy or not. All righty, thank you. Appreciate everything you guys do.
All right, looking at Zoom, ZM. This is a name we've owned for clients for a little while now. It bottomed. We bought it, I think, middle of last year, I want to say. And it bottomed around about $55 in August. And it recently hit a high around 91, but it's pulled back to 72 and didn't have a terrible day, only down a couple percent on the day. So good example of a company. It doesn't import anything. It's a software producer, and it's been dragged down, but overall, it's just kind of in a consolidation phase here, right at the 200-day moving average. Good support. We really like the name. It got egregiously overvalued during the pandemic and was one of the worst stocks to own back then, just because of how expensive it was. I'll give you an example. So right now, the enterprise value to EBIT is around 16, which is, for most companies, not crazy expensive or cheap. But if I zoom out to back in 2020, its enterprise value to EBITDA was at the peak 1,600. So 100 times the current valuation. Okay. Right now, it's I would say a bit undervalued. Mainly it's because they have a good balance sheet, tons of net cash on their balance sheet, talking about $7 billion in net cash. They have free cash flow of $1.8 billion, okay? And that's near an all-time high. And what are they doing with all that cash? Well, they are now buying back shares, which we really like. And their profitability is solid, around 12% return on equity. So great business with a great balance sheet, right-sized its profitability, and is now in an uptrend. So I think this pullback is something you definitely want to be buying. Okay. Thanks for the call. And I hope you've been telling your friends and family about our free podcast downloads, which you can find anytime over at iTunes or Spotify or Google Play, but also on YouTube in video form. And we have comments that come in via the YouTube comment section. So let's answer one of those now. JG says, "Hey, InvestTalk, can you explain MACD divergence? I always hear it on the podcast and wanted more of a clear explanation if possible." Well, if you're looking at any basic charting software, there's usually what's called MACD, moving average convergence divergence line. Now, what this typically will say, will show, is that when a stock is, say, it's an uptrend, okay, and it's making new highs, and it pulls back, and then it makes another new high, and the MACD does not. The MACD hasn't also made a new high. That's an indicator that the momentum for this move is not as strong as the price might make it seem, especially when it's looking at volume and that once again that momentum. And so it's an indicator that maybe this is a weak high, that uptrend is losing steam and ultimately will roll over and make a new lower low and maybe create a downtrend. And that's the same on the downside, where the market's in a downtrend or the stock's in a downtrend and it makes a new low, but the MACD is not making a new low. It's staying a bit elevated. That is an indicator that maybe the downtrend is also abating. So this is more of a visual thing. You definitely have to check that out, but it's one indicator. It's not the end all be all, but it's kind of the most basic way to see if the current trend is losing any steam or not. Let's go take a live call looking at Devon Energy from North Carolina. We're talking to Sid. How you doing, Sid?
Justin, thank you so much for picking the call. I'm doing good.
Good. You're looking at Devon Energy?
Yes, I do have this in my portfolio, around 0.3% of the size of the portfolio, and I'm holding for almost 1.5 years. More or less, it's sideways, somewhere between 35 to 42. And today it's dropped because of all this tariff and everything. I'm just thinking, is this a good opportunity to add more, or should we just wait for to bounce back and if it's a break-even point, should I sell it off? What's your long-term strategy on this one? Thank you so much.
Well, Devon Energy, it's one of the largest E&P companies in the United States and in Canada, and yields about 3%. The issue with them, though, is that they have a good amount of debt, and it's just not my favorite within the sector. So if I was going to add to my oil exposure, I would be looking at a different name. Simple as that. Ones that are much bigger, have better cash flows, have better balance sheets, and there are plenty of those out there. So Devon just isn't near the top of my list for companies to own within the space. Thanks for the call.
Okay.
Now let's try for another fresh question that came in via the comment section over on our YouTube channel. And Finance Anarchy says, I hold a small position in Coca-Cola, up a little over 30% of my portfolio. I've been thinking about selling it and using money to open position in ETF for Mexico emerging market. I was wondering what your thoughts are on that. If you still see Mexico as a good place right now, given whatever is happening with tariffs. I'm wondering if iShares Mexico ETF or the State Street Mexico Mix ETF would be good options. Looking at EWW is the iShares, EWW. And guess what? It was up 4% today. Now we have some Mexican exposure in our portfolios, but ultimately, I think they're going to be the longer term winner of this. We need a close relationship with Mexico more than any other country, I think, in the world. Because they're our partner. They have a much bigger population than Canada, and they have a great demographic. They have a lot of young people, hard workers, and obviously infrastructure that is integrated with the United States. Now they have their issues, certainly, with the cartels and corruption within the government, etc. But the human capital there is just undeniable. And obviously with these tariffs, they are now exempt and they are the relative winners. So, if you're going to look for a country out there, then Mexico definitely is up there as ones to buy. So yeah, I would do it. I would move some money from Coke over to Mexico. Thanks for the call. Now let's keep things moving and play another listener question from 888-99-SHARP.
I have a question about a company called Atkore Inc., ticker symbol ATKR. Wondering what you guys think of the company and would you consider getting in? Can you let me know about its fundamentals and analysis on this? Thank you so much. Have a great day.
All right, looking at ATKR, and this is certainly a good company, but it's in a downtrend because of the reduction in demand for the for data centers, and that looks like it's peaked out. It looks like Microsoft is pulling back, and earnings are declining for this name from $21.54 in 2022 to it's earning $6.23 this year. Relative strength is at 9. It was down. Let's take a look here. It was down $6.49, over 10% on the day. And let me take a look at their balance sheet, ATKR. Yeah, they have a good amount of debt on their balance sheet. Yeah, there's no reason to get into this. I would absolutely pass on Atkore. Thanks for the call.
Unlock valuable financial insights and strategies by signing up for the KPP Premium Newsletter.
Hi, this is kind of a beginner question, but I just wondered if the dividend you get from a company is based on the number of shares you have in that company or the amount of money you have invested in that company's stock. Thank you.
It's very simple. The companies will pay a per share dividend. It might be 20 cents, it might be 68 cents, it might be $3 per share. Depends on the company. And then how many shares do you own? You multiply that number, that dividend per share times the number of shares you own, and that's the dividend you will receive. Very, very simple calculation. Now, there are different dates when it comes to a dividend. There's the X date. That's the date you have to own it by when that the trading market starts. on that day. So you have to own it basically by the close the previous day. And then you will be qualified to receive that dividend, but you won't receive it on that day. You typically receive it on the date it pays out, which is typically 2, 3, 4 weeks after the ex-dividend date. We have to look that up and check that out for each company that you own that pays a dividend. Now let's play 2 in a row right now.
Hi, Justin and Luke. Thanks for what you guys do. I'm calling today about copper. It's pulled back a little now, and I'm thinking I should add to my positions. I've held it for quite some time now, but I think it's time that it'll continue the rally and continue its uptrend. Specifically looking into Southern Copper, SCCO, and FCX, Freeport-McMoRan. I actually own both of them, but I want your help understanding why SCCO seems to be a little bit cheaper. It's done better. I was wondering if I should add to that stronger position or if I should add to my Freeport position. Maybe it would rally even more because it has not done as well. Or maybe I should just sell Freeport and just add to that stronger position. Let me know your thoughts on copper and what you think about these two companies and why Southern Copper is so much better. Thank you for your help. Bye.
Well, we own Southern Copper, so we like Southern Copper. It is a bit cheaper than Freeport, but it's better run. Now it has foreign assets, more foreign assets in South America, Central America, and that's I think why it's a bit cheaper, because there is some political risk there, but they've been operating for a long time with no issues, and they're very well run once again. Now, it is pulled back a little bit, and Freeport is a lot weaker. Its relative strength is only 20 versus Southern Copper. Relative strength is at 28 and is holding major support levels much better. And copper prices are pretty strong. And we think over the long term, there's a supply deficit here when it comes to copper supply. And so over the long term, you're seeing Southern Copper earnings this year and next year. Those estimates are going higher versus when you look at Freeport, those estimates are going lower. So we're a bigger fan of Southern Copper, pays better dividends, a bit cheaper, better technicals, etc. I would just buy more Southern Copper. Thanks for the call. Now let's talk a little bit about tariffs. This is the day to discuss tariffs, and it's important to look back in history and what tariffs have done when they were applied in the past. Now, in his first administration, Trump slapped a 50% tariff on imported washing machines. That was in 2018, and said it was a necessary safeguard to help domestic producers and retain and create jobs. Now, a few foreign producers did bring their manufacturing to the United States. Mainly, it was a Whirlpool. And that did help employment a bit. It created about 1,800 jobs. This is according to the American Economic Review. But the price increases cost consumers $1.5 billion annually. So what's the cost for 1,800 jobs? It's a tax on the consumer. These tariffs are taxes at the end of the day on the consumer. And they're highly regressive because people that pay them are mainly lower income individuals who, that marginal 10, 15, 20% on the products they buy eats into their disposable income a lot more than those on the wealthy side, right? Now, when you're going to buy a washer, you also typically are buying a dryer. So this also pushed prices up for dryers. And because typically they're bought in pairs. And so domestic producers decided to up their margins on both washers and dryers. And those domestic producers that were already producing here, well, they used the opportunity to just raise their own prices and their margins. Now, what about tires? This wasn't a Trump thing. This is actually an Obama thing. 2009. 35% in 2009. Now, what happened to tire production? It wasn't really shifted back here. It was to Latin America and Asia. Although in Obama's State of the Union address in 2012, he said that it created 1,000 new jobs. But Estimates say it cost consumers $1.1 billion for those 1,000 jobs. And what about TVs? This is also something that Trump implemented on electrical machinery and equipment from China. It was mainly applied to TVs. Now, TV prices continue to go down, so it didn't really have an impact. It just they fell less. So, overall, it can create some jobs, but the cost to the overall economy is far higher than any jobs it typically creates. For more insights and resources, visit us at InvestTalk.com. Let's go fit in a real quick question from the comment section on our YouTube channel. Jim Leahy says, what do you think of Voya? Voya, V-O-Y-A, Voya. And this is in the credit space. It provides workplace benefits and saving solutions, technology to U.S. employers for better financial outcomes. Voya Financial. And it is down dramatically today. Let me pull this up here. Now, it has retirement solutions. It also, remembering correctly, insurance, employee benefits. But it's down big today. Let me just pull up this chart here. Yeah, down 6% today. The issue is it's just the chart is terrible. Relative strength is 31. Expectations are coming down for this year and next year. Acquired One America. I know people at One America. Interesting. Okay. And I haven't looked at this in a while. Let me look at the debt profile. They do have a good amount of debt in their balance sheet, about $3.6 billion in long-term debt. I just don't love the trends here. I just think that the business is in a strong downtrend, or at least the chart is in a strong downtrend. And while I tend to like the business, it's deteriorating. And that is my worry. So it's a name to watch. It's interesting, but I don't love the balance sheet. I don't love the once again, the trends, analysts' expectations for this year and next year. And I would continue to hold on it until there's some sort of return to strength in the chart. And today's a good example, down over 7% today, worse than the market. And there's a reason for that. So pay attention to the trends in the market and what the market is telling you. And I would pass on Voya. Now I want to close up today and really give you a sense of how to frame your mind around this potential economic calamity. And that's really what it is. It's potential. It's bad policy. But it's all policy that we know Trump can change his mind. And there are checks and balances within the government to prevent something this bad from truly being implemented. So there's possibilities that this is the worst it gets and it only gets better from here. That's absolutely a possibility. You have to keep an open mind. You have to keep something that's, you have to be flexible in the way you think about these type of events. You also have to not allow your political bias to look at things one way or another. I always think of these in the lens of what a company is going to think. How companies think, how they plan going forward. Because ultimately that feeds into hiring, which feeds into wages, which feeds into consumer confidence. And without confidence from the consumer, without a surety from the business community that the current playing field will be in place, that will be fair, that will be reasonable, companies will end up doing nothing. In fact, they will retrench. They will fire workers. They will stop investment. Innovation will end. And the dynamism of our economy will grind to a halt. And that's what this is. This is a plan to derail our economy. It doesn't have to end like this. It doesn't have to be implemented this way. I would call your congressman. I would implore anybody who has a voice to speak up, regardless of political party, and prevent this from truly being implemented. It is probably the most important time economically in our history over the past 30 years. And unless it is rolled back, the damage will be wide-ranging. That about does it. I'm Justin Klein. This completes another InvestTalk program. We appreciate you for tuning in, liking and subscribing to our channel and our podcast. And be sure to make sure you make sure you review and rate us over on iTunes as well. And keep in mind that we can help you better understand your portfolio, your risk tolerance level, and whether it is set up to help you reach your investment or your monetary goals over the long term. Just head over to investtalk.com and click on Portfolio Review. Independent thinking, shared success. This is InvestTalk. Good night.